Welcome, grade 12s. Yes, accounting once again. Remember, we are preparing for the final exams, and today's lesson, we're looking at a little bit of this and that and this much more. So keep with us, because you'll see we were looking at pertinent, important aspects of the accounting curriculum. So from myself, Ashraf Patel, and yes, the crew, James and Abi, welcome aboard the flight, the accounting flight, to our final destination. Here goes. It says, calculate the following: the buyback of shares that will appear in the retained income note. Okay, now let's look at the information that we have. We are told that we have ordinary share capital at the beginning of the year of 4,620,000, and your share capital at the end of the year is 5,388,900, right? The question wants us to calculate the amount that will appear in the retained income note. Now, obviously, you know that this means that we have to calculate the average price of our shares. Let's see what's happening here. We are told that at the beginning of the year, which is the 1st of March 2015, we've got 2,310,000 ordinary shares were in issue on the 1st of March. During the year, on the 1st of April, we issued a further 390,000 ordinary shares. And at the end of the year, or sometimes during the year, 170,000 ordinary shares were repurchased in September at 3 Rand per share. Right, so obviously, the 3 Rand per share is the total amount that we are paying back per share. But what do we require? We require the average price per share to work out the price above the average price for the retained income note. Okay, now be careful here. Watch. Let's start off by saying we've got 2,310,000 shares, right? Then we issued a further 390,000 shares. Okay, so if we add that together, this will give us 2,310,000, 2,310,000, right, plus 390,000 to give me a figure of 2,700,000. Okay, but what happened? Watch what happened. We are told that, let's get there, right? We are told that we repurchased 170,000 ordinary shares were repurchased when? In September. Okay, this means therefore we got to subtract 170,000 shares, okay, and minus 170,000 shares will give me a value of 2,530,000 shares. Now, what is important here, extremely important, is the fact that we are given the balance of our ordinary share capital on the 29th of February. That's right. That is representative of how many thousand shares? Clearly you can see that the 5,388,900, so 5,388,900. Let's just check that figure. 5,388,900. Okay, there goes. That one there, we have to divide it by 2,530,000 shares. Why? Because that's the number of shares that we got left over at the end of the year. Okay, so therefore, let's do that. We've got 2 million. We got our 5 million 388,900 divided by 2,530,000. 2,530,000. And that will give you a figure of R2.13. Okay, now the R2.13 is your average price of your shares. Now the question that you may be asking is, why am I subtracting this 170,000 shares? Because those are the shares that we bought back, and the figure that is given to you is after your buyback. So this 5,388,900 is the value of your shares after you bought back, and that is represented by the number 2,530,000 shares. I hope you clearly understand that. Okay, fine. So now that we know that we bought back the shares at 3 Rand per share, so simple. If that was the 3 Rand that we bought back the shares at, we take that and we say fine, minus 3 Rand, and obviously your answer is 87 cents above the average price. Okay, that means you bought back these shares 87 cents above the average price. So obviously we would now take 170,000 shares times 0.87, because the price above the average price, and your answer is 147,900, and that is what's going to appear in your retained income. I hope that is crystal clear to you. So look at the calculations involved here that you had to use in order to arrive firstly at your average price per share, which was R2.13. Then these shares were bought back at 3 Rand per share. So obviously above the average was an amount of 87 cents, and that's the amount that goes to your retained income. Okay, next question. We now have to calculate the proceeds of the issue of shares for the cash flow. Now remember something. The most important is your ordinary share capital. Right, where do we start? We start off by saying that my opening balance in my ordinary share capital is 4,620,000. So 4,620,000 is my opening balance. Look at the method that I'm using in order to find what I'm looking for. Right, number 2. I also know that the closing balance is 5,388,900. 5,388,900. Okay, so opening balance, closing balance. There's my opening balance, there's my closing balance. What else do I know? Come on, from my previous calculation, I know that the average price per share was, and we calculated it, do you recall? The average price per share was what? We calculated it at R2.13. Right, okay, this means therefore that I can take my R2.13 and multiply it by what? The number of shares that we repurchased, which was 170,000. So clearly you can see, what am I calculating here? Let's do the calculation. And whilst we are doing the calculation, we'll do the talking as well. So 170,000 was the number of shares that we repurchased. 170,000. Okay, times 2.13. What was that? The average price of the shares, and that gave you a figure of 362,100. Let me take you back. What am I doing? The average price of the share is the amount that will feature in my ordinary share capital account. Clear? Right. Therefore, in this account here now, I've got my average price, of the shares that were repurchased. I've got my opening balance. I've got my closing balance. All that I need to do now is find the missing figure. And how do I do that? Very simple. This is what we do. We say 362,100 plus 388. No, it's not 388. Let's just get this calculator to a place where we can see all our figures. So once again, let's delete that. Let's go back to it. So it's 362,100 plus 5,388,900 minus 4,620,123, and that gives you a figure of 1,131,000. And this, grade 12s, is now what we call the proceeds of the new shares that were issued. Clear? Let's recap. And you can see why I'm recapping, because of its importance. Number one, slot in your opening balance. Let's take another color there. There's your opening balance. Number two, slot in your closing balance. There's your closing balance. Number three, slot in the buyback of the share. But be very careful. You want to buy back, and the price that goes into your ordinary share capital is the average price. Therefore, the 213 times 170,000, because the price above the average price is what featured in my retained income note. Recall, we just did that calculation, right? Just one more thing. If you take the 170,000 shares and you multiply it by 3 Rand, let's do that. Okay, so we've got 170,000, 1, 2, 3, times the 3 Rand, that's 510,000. This 510,000 will be the total price that we paid for those shares. And this is what's going to go into your cash flow statement. Remember, for the price of the shares that were repurchased. I hope you understand what we have done so far. Clear, guys? Brilliant. Let's move on. Now we are told that the financial year of the firm is the 1st of March to the 29th of February 2016. You are given your sales figure of 3,402,000, which is a given. You are expected to calculate the cost of sales. Straightforward, isn't it? However, you are told that goods are sold at a profit markup of 50% on cost. Okay, so step number one, this is what we do. That's what we're going to be doing. We say that my cost price, my markup, and my selling. Cost is 100, my markup is 50 given to me, my selling therefore is 150. Clear? Remember what we said. The amount that you want to calculate must always be on top, not inside, on top. 100 over my selling price, which is 150, times the actual selling price. And you want an easy way to remember that, don't you? So, ASP, that stands for Ashraf Patel. Aha, easy way to remember it, isn't it? So, 100 over 150 times the actual selling price is 3,402,000. However, watch this. They tell you that the sales amount includes an amount of 27,000 Rand for old stock that was sold to cash customers at 10% below the cost. Okay? This was sold at 10% below the cost. So step number one, watch what I'm going to do. I take my 3,402,000, 3,402,000, which was the original sales price. I subtract the 27,000. Okay? Remove the 27,000. And so we've got 3,402,000 Okay, have we got all the zeros in there? 3, 4, 2,000, right? Minus 27,000. And this will give me a figure of 3,375,000. Okay, got it. So we got 3,375,000. Now, if I take my 3,375,000, then it's easy to calculate my cost on this figure. Why? Because it's 100 over 150 times 3,375,000, okay? Because those were your normal selling prices where you sold the goods at its normal price. Therefore, we've got that times 100 divided by 150, and this will give me 2,250,000. Okay, so the 2,250,000 would be the cost price of that sale there. Okay, now, does that conclude the question? Certainly not, because there's a component that we still have to calculate. And in order for you to know how to calculate that component, you have to stay with me, because I'm going to take a break, and as soon as we come back, we're going to do the second part of that calculation. See you just now. Welcome back, grade 12s. Yes, remember we were busy with that calculation regarding the cost of sales? Now, I'm going to ask you, based on the information that you have here, right? I'm going to check if you can do the calculation for the remainder of the cost of sales, taking all this information into account. You've got that information by you, and you've got 1 minute, guys, to work out for me the calculation of the remainder of the cost of sales. I've done one part for you already. I expect you to now do the second part. Your minute starts now. Go for it. Welcome back, grade 12s. Okay, dokes, here goes. Right, now you are told that you had sold goods to the value of 27,000 Rand, okay? But these goods were sold at 10% below cost. In other words, you sold these goods 10% below cost. There's your information, meaning that this 27,000 is equal to 90%. Why? 100% minus 10 is 90%, 10% below cost. What are you trying to determine? What was the total cost, the actual cost price of these goods? So you say X is equal to 100%. Let's do our calculation now. So all that we do is we take 27,000 times 100 divided by 90, and this is equal to 30,000 Rand. Voila. What have I done? I've now calculated the cost price of those goods that were sold at a special sale. In other words, my total cost of sales will now be, watch, open your bracket, 2,250,000 plus the 30,000 Rand on the special sale. So we say that plus 2,250,123, and there goes. Your answer is 2,280,000. That is your cost of sales figure, 2,280,000. Got it? Okay, next question. I told you we got a mixed bag for you today, and you can see the idea is for you to understand how to do these calculations, because obviously they form part of your adjustments. It says here that your financial year starts on the 1st of March and ends on the 29th of February. We are asked to calculate the director's fee as it would appear in my income statement. Right, what do we know? We are told that the director's fees amounted to 316,100, right? We are told that the company had 2 directors on equal pay from the 1st of March. That means they were employed from the 1st of March until the 29th of February, 2 of them. In other words, the first one was employed for 12 months, agreed? And the second one was employed for 12 months as well. Clear? So it told you 2 directors on equal pay, both of them equal, from when? From the 1st of March. A third director was appointed on the 1st of September, right? So let's count. It's September, October, November, December, and January. I'm stopping at January. Why? Excuse me, it says here that this director's, watch, what's important, read. RTFQ. You know what it stands for, don't you? Read the full question. We're not going to swear, James. We are on TV, so we can't swear, right? Okay, so what are we saying? We're saying, read the full question. What are you told? This director's fee for February 2016 was not yet paid. Which one? The third director. So he was appointed on the same fee structure, but his fee for February is outstanding. So watch, let's go again. We've got September, October, November, December, and January. 1, 2, 3, 4, 5. So we add the 5 months there. So this will give me a total of 29. Why? 12 plus 12 is 24, plus 5 is 29. Okay, what can I now do? All that I do now is I take my 100, okay, and I divide it by 29. Why 29? Because one director was paid for 12 months, the entire financial year. The other director was also paid for the entire financial year, another 12 months. And the third director was only paid for 5 months. That means he did not or she did not receive the February amount. Therefore, 29, and this is equal to 10,900. Watch. Now we say 10,900. So, in other words, we say open bracket 316,100 plus the 10,900. Okay? And then this will then give me, so we've got the 10,900 plus the 316,100, and this is equal to 327,000. That's the figure that would appear in my income statement, okay, or my statement of comprehensive income as it is now known. So what have I done? I've done the adjustment in terms of the information that was provided. At the same time, remember that in your balance sheet, right, under trade and other payables, yes, under trade and other payables, what was my adjusting entry? A debit to director's fees and a credit to accrued expenses. So under trade and other payables, under my item accrued expenses, I would include my amount of 10,900. Clear, grade 12s? Again, I'm stressing the importance of reading the information correctly. Once again, just to make you absolutely certain, it said this director's fee, which one? The new guy, was not paid for February. Therefore, we have the 5 indicating the 5 months since the appointment. Okay, brilliant. Let's move on. In this question here, we are told, once again, the financial year starts on the 1st of March and ends on the 29th of February. It says here, show the provision for bad debts figure that will appear in the balance sheet, right? Or, remember, it's now called the statement of financial position. So either called balance sheet or statement of financial position. You are expected to calculate that figure based on the information that is given to you here, right? And there's the information that's given to you. You have, okay, we'll give you 2 minutes because of the number of entries there. We'll give you 2 minutes to see if you can get to that figure. Your 2 minutes start now. Go for it. Welcome back, grade 12s. Okay, let's start off by doing this here. We start off by saying, this is the information that's provided, okay? And what do we have here? Let's do a debtors control account in terms of information that we have. Right, what do we know? Our debtors control has a balance of 280,200. So 280,200 is my balance on my debtors control. First one, a check received in settlement of an outstanding balance of 3,600. That means the account that was outstanding was an amount of 3,600. Less the 5% discount was dishonored due to insufficient funds. Double entry. Watch. A debit to debtors control with the full amount, which is 3,600. So you debit your debtors control. What are you going to credit? We don't need this, but just to show you that you're going to credit bank and you're going to credit your discount allowed. Are you with me? Because there was a discount involved. Right? Let's work out the discount. So all that we say is fine. It's 3,600. 3,600 times the 5%, that's equal to 180. Okay, so if that was 180, your discount was 180, then obviously this figure would be 3,600 minus your 180, and that would be an amount of 3,420. Okay, so that's 3,420. Now the reason I'm showing you these entries here on the side is to make it aware to you that because there was a discount allowed involved, the contra entry affects three accounts. You would debit debtors control with the full amount of 3,600, and you would credit bank with 3,420, and you would credit your discount allowed with 180 Rand. Remember that this 180 is going to impact on your income statement because you have an item for discount allowed. Clear? So whatever the total is here, whatever it's going to be, that minus that is going to appear in your income statement. Whatever your bank balance is here, that would impact on the calculation. So if the cash and cash equivalence note is asked for, you would see that it would impact there as well. Right, coming back to my debtors control. Then we are told that a debtor with a credit balance of 1,200. Now watch this here. Always do this so that you understand what you are doing. There's your 1,200. It's a debtor, so there's the debtor. Okay? A credit balance of 1,200, you want to transfer it to your creditors ledger. What do? You will debit that account to close it, and therefore this debit tells you that you have to debit your debtors control account with 1,200. Clear, guys? So put in the original position, and the original position was a credit in the debtors control of 1,200. So clearly you can see that your contra will be a debit to your debtors control and a credit to your creditors control. Can you see your entry? There's your entry. I'm just doing it on the side to give you what entry you would put into your debtors control account. There's your entry. And the reason I isolated it is just to show you that the 1,200 is then taken out of debtors control. But the original entry, in order to do that, was to debit your debtors control. Okay? So this then leaves you with all the entries that you have in your debtors control. Now, we've got to work out our provision based on 2.5%. And obviously, you want to know how we're going to do that. So the place to be, guys, is with Ashraf and crew. We'll see you in just a while. Welcome back, grade 12s. Yes, we're busy with the debtors control account. Remember, the question we had to answer was, show the provision for bad debts figure that will appear in the balance sheet. Okie dokes. Right, now that we have all our adjustments for debtors control in place, we can go ahead and do that. So all that we do is, we got a 280, 200 as my balance, plus the 3,600, which was my dishonored check, plus the 1,200, which was the transfer, to give me a total of 285,000. So that is your new balance in your debtors control account. Right, and it must be adjusted, and the adjustment said we must adjust it to 2.5%. Okay, let's do that. So we take that times 2.5%. Okay, and the answer is 7,125. That's the amount that's going to appear in my balance sheet as my new provision for bad debts. But I want to take this question a wee bit further. Although the question didn't ask for it, I want to take it a wee bit further just so that you understand what's happening. Watch. So here's my provision for bad debts. Okay, and the provision for bad debts had a balance of 9025. So 9025. And yes, somehow we find that people always battle with this here, so maybe a good time to do it. 9025 is the balance in my provision for bad debts. What do I know? I know that my new provision has to be 7125. Remember, that's the one that goes to my balance sheet. That's what the original question wanted. Right, but if we were doing the income statement, what would we do in this case here? Watch. You take your calculator. You've got the 7125. I'm just going to take a shortcut here. Okay, let's go the proper route. You've got 9025 minus 7125. Clearly you can see that in order to arrive at this situation here, what do we need to do? We need to debit the provision for bad debts to reduce it. And once again, what type of an account is this? A balance sheet account. What type of balance sheet account? It is a negative asset, right? To decrease a negative asset, you need to debit it. There's your debit entry. As a result, you now have a new balance of 7125. Now, this 1,900, what will happen to it? This 1,900 is what's going to appear as provision for bad debts adjustment, right? A credit of 1,900. And remember, when this account is credited, it now becomes an income, and you show it under your other incomes in your statement of comprehensive income. Clear, guys? I hope so. So what I've done with the provision, I've showed you what goes to the balance sheet. The new figure that you calculated goes to your balance sheet, and the adjusting amount by which you adjusted that provision goes to your income statement, also known as the statement of comprehensive income. Clear? Great stuff. Next one. The financial year starts on the 1st of March and ends on the 29th of February. Calculate the rent income figure for the statement of comprehensive income, also known as the income statement. You are given the rent income and you are told that your rent for February 2016 was outstanding. Note that the rent increased by 7% on the 1st of January 2016. You have 1 minute to calculate your rent income figure. Go for it. Welcome back, grade 12s. You remember from our previous lessons, we've had something like this before. Let's do it one more time so that you are absolutely sure how to handle a question like this in the exams. Right, what do we know? That my old rental prior to the increase was 100, right? 100%, that's all that I know. And for how many months was that old rental? Because if your year started in March and the rent only increased in January, so this would mean that March, April, May, June, July, August, September, October, November, and December is 10 months. So there's the 10. So those are the 10 months. And which are those 10 months? Starting in March, ending in December. And that will give you 1,000. Clear? Right. What happened to your rent subsequently? Your rent increased by 7%, so it's now 100 plus the 7 to give you 107. And For how many months did that happen? That happened for 1 month, because they're telling you the rent for February is outstanding. So this only the January rent did we have at a 107. So 107 let's just do that again. 107 times 1 is equal to 107. Right, so let's add this. 1107 is equal to, right, what is my rental figure? 98,523. Clear? What are you looking for? What is it that you want to calculate? You want to know what was the rental for the 1 month that was outstanding. Now that month was a 107 month. Therefore, 107 is equal to my unknown. Clear? Right, let's do the calculation now. So, all that we say is 98,523 times 107 divided by 1107, and it's equal to 9523. What is that? That's the 1 month rental that we have not received as yet. And therefore, what are we going to do now? Very simple. Open my bracket for rent income, put in the 98,523, which is the given figure, right? It's rental that is due to us that we haven't received, so we will debit accrued income and credit my rent income with 9523, and obviously we've got the 9523 plus 98,523, and that gives you your rental figure of 108. Let me just check if that is, let's just do that again. 98,523. Those figures are not right. 98,523 plus 9523, and that is equal to your new rental figure of 108,046. Right, so this means therefore that your rental was outstanding for 1 month, and therefore your double entry was a debit to accrued income, a credit to rent income, and there's your new rent income figure. Clear, guys? Okay, let's move on to the next question. It says here that we're dealing with an asset disposal, right? Financial year given to you, we are expected to calculate the profit or loss on sale of asset. They say the asset disposal amount represents the cash received for the sale of equipment on the 31st of December 2015 as recorded in the CRJ. Apart from this, no other entries were made. Okay, now, very simple. Whenever you are dealing with an asset disposal question, remember the table. Depreciation, cost price, accumulated depreciation, carrying value, selling price, profit or loss. Let's go for it. We know that our selling price was the amount that was given, which was 15,000. So there's my 15,000. Clear? Right, what else do I know? I'm told that the cost price of the equipment that was sold was 66,200. Clear? And the accumulated depreciation was 43,225, and immediately I put a plus sign there. Why? That's my balance at the beginning of the financial year. How do I depreciate? I depreciate by 15% per annum on cost. So immediately I go in and do my calculation, and I say art, amount, rate, and time. So I take the 66,200 over 1 times my rate is 15 over 100 times my time. When did I dispose of the asset? Watch. The asset was disposed of on the 31st of December. So in other words, it's March, April, May, June, July, August, September, October, November, December. 10 months. So, times 10 over 12. Okay? Let's take our calculators and do that calculation. So what do we have? We've got 66,200 times 15%, right? Times 10 divided by 12. And my answer is 8275. Watch, 8275 is my depreciation. Add it here, 8275. So we got that plus 43,225. What am I doing? I'm adding my accumulated at the beginning of the year to my current depreciation, and that gives you an amount of 51,500. Right, so that's equals to 51,500. I can now calculate my carrying value, which is that minus 66,200. Remember, I'm taking the shortcut, which is 14,700. It's just ignore the sign there because I just used the figures just to quickly get to my answer. Now the question that you ask yourself: did I dispose of my asset for greater than the carrying value, less than the carrying value, or equal to the carrying value? Watch. My selling price was 15,000 and my carrying value was 14,700. So obviously my selling price is greater than my carrying value. Therefore, this tells me that I have made a profit on sale of asset, and the profit on sale of asset is 300 Rand. I have not made a single accounting entry, but I've calculated my profit or loss on sale of asset just based on the information that I'm using here. Right, another hint of advice. Watch. This depreciation would be part of your depreciation in your income statement. 8275 would be one component of your depreciation. You would still bring in your depreciation on your old equipment, the equipment that you did not sell and you utilized for the entire year. So that component you would add to it. And if you had bought new equipment, that would also be depreciated, and that would then give you your total depreciation for your income statement purposes. Another important factor that you must take into consideration is that this carrying value here, whenever you are doing this, put a big 3 alongside it. Why? Because this carrying value is what you're going to use in note number 3. When you are doing your note number 3, the fixed assets note, and it says disposals at carrying value, that's the figure that you're going to include in note number 3. So once again, grade 12s, important, draw up your table. Put down this information. Look at the method that I've used, because if you use that method, I promise you, asset disposal will be a piece of cake. And you know my favorite? Chocolate cake. That's right. Well, grade 12s, that brings us to the end of today's lesson. From myself, Ashraf Patel, and the crew, James and AB, we wish you well for the exams. And yes, we want you to be, what do we want you to be? We want you to be the accounting. Rather, we want you to be Ashraf's accounting shining stars. Keep on shining bright, ace that paper, keep your feet on the ground, and be good. Until the next time, cheerio.